And last, we're going to look at causal models. These are models that basically are external, and they can either be simple or they can be complex. It just depends on how you want to do them. And I'm not really going to look at all, I'm not going to show you really great examples of all of them, but basically these are often used also. What I do want to start looking at is what we call, I want to start looking at sales forecasting for a startup business. Because remember, when you're starting a business, you don't have any historical data to go by. You only have your expertise, your knowledge. You can project revenues. This is called revenue projection. And this is the start of the Proforma income statements, okay? So here's what you first of all, you have to have some, when you're going to do a sales forecast for a startup business, you've got to have some expertise or experience of how much you're going to charge, how much it's going to cost you, all the revenue you're going to make. You can look up, if you don't have this information, there's something called EDGAR, and you can pull reports from other companies similar to yours. Just FYI. So there's three types of expenses when you're talking about businesses. You have startup expenses. So startup expenses are expenses that you're going to have that will actually start the business. Now you might continue these type of expenses as you run the business, but they're called startup expenses. They're usually not going to be incurred again in that format. Then I have fixed expenses. Fixed are like my rent, my utilities, my insurance. It doesn't matter how much I sell or don't sell, a fixed expense will be the same. A variable expense is tied to the quantity that I sell or don't sell. The more I sell, the more it costs me. The less I sell, the less it costs me. And with this type of information, we're going to develop a revenue forecast or a projections, a cash flow projections. So we need to figure, and we're going to go best case, worst case. We're going to look at a couple things. So we need to know how many hours per day we're going to work. 10 is the best, 4 is the worst. How many days per week? 6 is the best, 4 is the worst. How much I'm going to pay per hour. This is what I'm billing the customer, but this is what it's going to cost me. But if I have an overtime, this is what it costs me. Here's how many workers I'm going to have and how many weeks they're going to work per year. And so then I'll figure out how much profit, and I'll do best case and worst case weekly, and then multiply it by 50 to get annually, okay? So forecasting, revenue forecasting is really, really important when you're going to do Proforma financial statements. This is one of my expertise in the area of startup businesses that I do for nonprofit organizations. Nonprofit organization I volunteer for is I help business owners figure out what is their startup forecast or their revenue projections, it's called. So we're going to start with Proforma financial statements. Remember, I said Proforma financial statements. Hold on. Sorry about that. Proforma financial statements are projected. So I'm going to do an income statement, a cash budget, and a balance sheet. Remember, this is best guess based upon my revenue projection and my anticipated cost, what it's going to cost me. So here are income statements for actual time periods. So this is for this month. Apparently they're doing it for next month. So this is for this year. I'm sorry. This is an income statement for this year. This is what they project for next year. Okay, they're not just going to make these numbers up. This is where I talk about my WAG, my wild ass guess, or my SWAG is scientific wild guess. So how do I project what's going to happen in 2013? I'm going to use a revenue projection, and this is an eye chart for you guys, okay? So basically, this is saying how much did I do October, November, December of last year, and then based upon how things are going to change, what am I going to do for the whole months of 2013, okay? And I actually have this on an Excel chart that you could actually fill out. If anybody's interested, contact me. I'll send this to you. Okay, so here's my balance sheet for the year ending. So if I know again what my actuals were, then what I'll be able to figure out what my balance sheet might estimate it. But there's a couple different ways to do the balance sheet and the performance income statements. One of them is called using a percent of sales. Okay, this is called percent of sales method. And what happens is I'm going to say, okay, sales will increase by 10%. So next year's sales will increase by 10%. But then I have to realize that if sales go up by 10%, what's my costs are going to go up by a certain percent, and everything will go up percent after that. So here's some formulas for this. For using the balance sheet only, we're talking about the balance sheet entry in dollar amounts divided by the actual net, okay, times 100. The reason I'm timesing 100, okay, so for example, the balance sheet entry. So we're going to take each entry on the balance sheet. We're going to take the cash divided by the net sales, multiply by 100, which will turn it into a percent. So if I'm going to use the percent of sales method, then my cash will go up. If my cash is 4,000, my total sales are 200,000, my cash is going to increase by 2%. And so I'm going to do that with all my balance sheet items. See here? So I took this divided by the 200,000, this divided by the 200,000, this divided by the 200,000, and here are my percents. Okay? And so what I'm going to do is 200,000 was my actual sales in 12, 250,000 is my projected sales in 13. So I'm going to take these percents times the 250 to get these numbers. Okay? It's called a percent of sales on the balance sheet. There's a few more slides, but I'm going to let you go ahead and finish looking at them on your own. They're mostly charts and graphs, and this is where we're going to stop for chapter 6.